please come to now some questions we will solve. Otherwise you will get bored. So come to question number 1. Question number 1, you can see there. If the sale price of the open-ended fund per unit is 12.30 and the fund is sold with a front-end load of 5%, and the fund is sold with a front-end load of 5%, what is the NAV? What is the NAV? So what is given sale price? Rupees 12.30. What is given front end load? That is called entry load, and that is given 5%. And then they are asking you to find what is NAV. So try yourself. What is NAV? Try yourself. Now check the answer. The formula for calculating sale price is NAV plus entry load. NAV plus entry load. So the equation will be 12.30 equal to, let NAV be X and entry load will be 5% of X. Entry load is on NAV. Entry load is not on sale price. So my equation will become 12.30 equal to 1.05 X, and therefore X is equal to 12.30 divided by 1.05, and if you solve it, how much you are getting? 12.30 divided by 1.05, how much is that? That is equal to rupees 11.7143 approximately. So that would be the answer. So how to move from sale price to NAV we have learnt in this example. Next is question number 2. Question number 2 is the NAV of the UTI mutual fund on 2nd January 2006 was rupees 23.45. If the fund charged 2% as entry load and 0.25% as exit load, what are the sale and repurchase prices to the investor? So just application of formula. First write down sale price. Sale price is equal to NAV plus entry load. NAV is 23.45 plus entry load is 2%. Plus entry load is 2%. So write down the answer, 23.45 plus 2%. So that is around rupees 23.919. You can write up to 4 digits. NAV and units. NAV and units we can write up to 4 digits unless other instructions are given. Now write down repurchase price. Repurchase price equal to NAV minus exit load. 23.45 minus 0.25%. 23.45 minus 0.25% is how much? So final answer will be in rupees 23.3914. 23.3914. You can write in 2, 3 4 digits, no problem, don't take tension. So this is your problem number 2. Now we'll solve problem number 3. The NAV of the bond fund is 30.7250. The fund charged 1.25% as entry load and 1% as exit load. If an investor wants to invest, if the investor wants to invest rupees 16,000 into this fund, if an investor wants to invest rupees 16,000 into this fund, what is the number of units he will get? First you will try 5 seconds. What is the number of units he will get? Time over. So first we'll have to check whether I need sell price or whether I need repurchase price. If the investor wants to invest, the mutual fund will sell units to him. Mutual fund will apply selling price. So this question will have 2 steps. Step 1, first we need to find sell price. Sell price will be NAV plus entry load. NAV is 30.7250 and entry load is 1.25%. So check the answer. 30.7250 plus 1.25%. So are you getting 31.1091 rupees? And then you write down step number 2, number of units he will get. So he has 16,000 rupees to invest. Mutual fund will sell him 1 unit for 31.1091. So 16,000 divided by 31.1091, and that is approximately equal to 514.3190 units. So this time write units, don't write rupees. This is unit. Okay, next paragraph, question number 4. Next point, question number 4. The NAV of an equity fund was 33.15. The fund charged 1% as entry load and 1.25% as exit load. If an investor wants to withdraw, now the question is, if he wants to withdraw rupees 18,000 from the fund, what is the number of units he will repurchase? So if the investor wants to withdraw rupees 18,000 from the fund, what mutual fund will do? Mutual fund will repurchase units and pay him 18,000. Mutual fund will repurchase unit from the investor and pay him rupees 18,000. So which rate will be applicable now? Sell price is applicable or repurchase price is applicable? So you will say repurchase price is applicable now. So step number 1 will be repurchase price is equal to NAV minus exit load. NAV is 33.15 and exit load is how much? 1.25%. So tell me 33.15 minus 1.25%, that is 32.7356 rupees. And step number 2, number of units that will be repurchased. Number of units that will be repurchased equal to, you have 18,000 and the rate at which it will be repurchased will be 32.7356. So tell me the answer now. 18,000 divided by 32.7356. So are you getting around 549.8601 units? You can write approximately because of some difference in the last 2 or 3 digits, but it's approximately 549.8601 units. Come to next question 4. Question number 5. The NAV of a bond fund was 35.5750. The entry and exit load were 0.75% and 1.5% respectively. If the investor wants to buy 2000 unit, what is the amount he has to pay? If the investor wants to buy, mutual fund would sell him units. Mutual fund would sell him the units. So this type, step 1 will be sale price. Investor wants to buy means mutual fund wants to sell. Formula is NAV plus entry load. NAV is 35.5750 and entry load was 0.75%. So let me also check, you also check 35.5750 and plus 0.75%. So that is equal to 35.8418 rupees. And step number 2, amount to be paid. Amount to be paid to acquire 2000 units is 2000 into 35.8418. 2000 into 35.8418 equal to rupees. How much is that? 71683.60 approximately. Some rounding of difference here may change your answer by few paise, but still concept is understandable. This is how they calculate how much amount you will have to pay, how many units you have to buy or repay. One more practice, then we'll take one advanced version. This is like a roller coaster. At first you will go slowly, now you'll reach the peak, and then question number 7 will come. The NAV of a bond fund was rupees 40.4250. So you'll see in the question also they give in 4 digits. The entry and exit load are 0.25% and 2% respectively. If an investor wants to redeem 2500 units, the investor wants to redeem 2500 units, what is the amount he will receive? So which rate will be applicable now? Repurchase price will be applicable. So step 1 will be repurchase price is applicable NAV minus exit load. 40.4250 minus 2%. So try 40.4250 minus 2%. So that is equal to rupees 39.6165. Is it right? Let me try again. 40.4250 and minus 2% is 39.6165. And step number 2, amount received is how many units he wants to repurchase? 2500 into 39.6165. So he will get rupees 99,041.25, 99041.25. Are you getting the same answer? After these basic questions, now I will give you a little advanced version. Question number 7. An investor holds 1000 units in a bond fund. The current NAV is rupees 12.45. He would like to switch his holding to an equity fund whose NAV is rupees 15.65. If the exit load for the bond fund is 0.5% and the entry load for the equity fund is 0.75%, what is the value of his holding in the equity fund? What is the value of his holding in the equity fund after the switch? So first, this person was holding 1000 units in bond fund. He is holding 1000 units in bond funds. So what he will do? He will redeem and then invest in equity fund. So he wants to switch. This is called switch from bond funds to equity funds. And then the question is, what is the value of his equity fund after the switch? What is the value of his equity fund after the switch? So first he will have to sell these bonds, means you have to apply the repurchase price here. So one step will be to find out the repurchase price of bond funds. Then you will get amount received on redemption of bond fund. Then you will calculate the sale price of equity fund. Don't do anything, just understand. You will calculate sale price of equity fund. This amount that you will receive will be invested at sale price of equity fund. You will get the number of units of equity fund received, and number of units of equity fund multiplied by NAV of the equity fund, that is the value of his holding in the equity fund. So basically your answer will be number of units of equity fund into NAV of equity fund, and you have to now find out what is the number of units of equity fund. If you can find that, then you will be able to get the answer right. So please try yourself. I'll give you 10 seconds to try. So try, see if you can do it. All of you are trying. First find out the repurchase price of bond fund. Then calculate the amount you will receive on redemption of bond fund. Then find out the selling price of the equity fund. Then find out the number of units of equity fund you will receive, and then multiply by NAV of equity fund. That will give you the value of equity fund. So 5 seconds more. Time over. Now I will solve. You will check the answer. Everything you can do on your calculator also. The purpose is student must learn. So write down step 1. Step 1 will be calculation of repurchase price of bond funds. Calculation of repurchase price of bond fund is equal to NAV minus exit load. How much is the NAV given? 12.45. And how much is the exit load for bond fund? 0.5%. So take your calculator, 12.45 minus 0.5%. So that comes to rupees 12.38775. You can write down, no problem. Step 2, write down amount received on redemption of bond funds. So you will have how many units now? You have 1000 units. 1000 units into 12.38775. So multiply by 1000 unit. So now you have rupees 12,387.75. So they will give you 12,387.75. This is how they do the calculation in case of switch. Now what will be step 3? Step 3 will be sell price of equity funds is equal to NAV plus entry load. NAV of equity fund is how much? 15.65, and entry load is how much? 0.75%. 0.75%. So type 15.75, 15.65 and plus 0.75%. So you are getting 15.7674. You can round off in 4 digits rupees. Now listen to me. This is the amount you have. This is the sale price per unit. So what will be step 4 now? Step 4 will be number of units of equity fund acquired will be 12,387.75 divided by 15.7674. 12,387.75 and divide by 15.7674. So that comes to 785.6558 units. And then step number 5, that is your question, value of holding in equity fund. Value of holding in equity fund will be equal to 785.6558 units, and the NAV of the equity fund is 15.65. NAV is 15.65. Multiply by 15.65, and that comes to rupees 12,295.51 bracket approximately. So this is how you will solve the problems of entry load, exit load, switch. Now we'll come back to various mutual fund schemes. Come to mutual fund schemes again. Now the next way of classification is based on investment objective. So first our objective would be growth in the value of our investment, capital appreciation. Investor is looking for capital appreciation, growth in the value of his fund. So to satisfy such investor, there are growth funds. Growth fund offers capital appreciation. Growth fund offers capital appreciation as well as a variable dividend opportunity to the investor. So good for which kind of investor? Good for investors who are willing to take risk. Good for investors who are willing to take risk and who can invest for a longer term. Good for such investor who are willing to take risk and who can invest for a longer term. Such funds mostly invest in equities, shares. You can write such funds invest mostly in equity shares. Sorry. So in case if you have money to spare for some years, you are not in the need of money, you can invest in growth fund, and then normally they will give you two options. One option is you don't want dividend, then your money will keep getting reinvested, but if you need dividend also regularly, then you can tick mark dividend option. And they will show you, they will give you dividend also on the regular basis. But remember, these are risky mutual fund. If you find growth word after the name of a mutual fund scheme, HDFC growth fund, Reliance growth fund, that means they are going to invest in risky equity stocks. Risk and return both are high. So last point I will write here, risk and return both are high. Now come to income funds. Income funds are the funds which usually invest in debt securities. So underline this line, it's already printed in your book. So they invest mostly in debt funds. They are less risky. And offer lower return because they themselves invest in instrument like bonds and debenture. So if they will earn less, they will pay less return to the investor. So good for which type of investor? Good for investors who don't want to take risk. So if a person has retired, he has no source of income, he has received pension, gratuity, PF. So now he can park his money in income funds and this income funds will give him regular income. These income funds will give him regular income, and you can decide the period also when you want to receive income. So some of you can tick mark monthly income. So every month they will pay you dividend. You can tick mark quarterly income scheme. They will give you quarterly income. So according to your cash flow needs, you can choose the time when the dividend should be paid by these funds. So they are good for people who don't want to take high risk, happy with the lower return. And sometimes suppose you have surplus amount only for a given time period, surplus amount only for a small period, let's say 2 months or 3 months. So you can't take risk with that money. So better you park that money in the income fund. So one more point I will give you. For parking temporary surplus, you know that you will require funds after 1 month, 2 months, 3 months. So you can't take chances with that money. You park in income funds, and this is a balanced fund. So this is good for investors who can take moderate risk. Why the risk is moderate? Because these mutual funds invest in equities and bonds both. So it has some advantage of growth fund, it has some advantage of income funds also. And this is a very popular scheme because most people will not like to take too much of risk by investing in growth fund, but at the same time they don't want to completely invest in income fund which gives you very lower return. So somewhere between the two you have balanced fund, and they invest in equities and bonds both. Like they may invest 60% in equity, 40% in bonds. So even if the equity market crashes, you will not lose all the value. Bonds will still be there. So they are very popular schemes with a lot of investors. And the next one is ELSS, tax saving funds. If you invest in these schemes, you get tax deduction under the Income Tax Act. So this will be useful for your tax planning. So you have to see what is the current tax law, accordingly write a note. For example, you will say under section 80C, you can invest up to rupees 1,50,000 and get deduction. So directly it is deducted from your gross total income and you save taxes. So that is tax saving funds. You will invest in mutual fund. Where will mutual fund invest? Accordingly they are classified as investment types, and there can be many. We have written few examples here. Money market mutual funds. What are money market mutual funds? First of all, what is money market? Money market means a market for short-term securities. Money market is a market where short-term securities are traded, where the maturity of the security ranges from 1 day to 1 year. Example of money market securities are treasury bills, that is bill issued by the government, commercial paper, that is short-term debt instrument issued by reputed corporates, and certificate of deposit. So these are short-term deposits accepted by banks, certificate of deposits. They are short-term in nature. They are like FD, but the maturity period can be few days to few months up to 1 year. These are very safe instruments because these are debt instrument, maturity is also less, so the risk is very less. So who will park his money in money market funds? Those investors who don't want to take risk, those who want to invest their surplus money which they may require after some time. So instead of parking your money in saving account or current account which pay zero interest or low interest, you can invest in this security and you can still get some return, okay, which may vary from say 4-5% to 7-8%, good enough. Then there is gilt funds. What are gilt funds? These invest in government securities with medium to long range maturity. Okay. If it is less than 1 year, it's already covered under money market funds. Maturity period is more than a year, and these have very low default risk. Very low default risk. Why? Because they invest mostly in government securities. Risk is low, returns are low. Risk is low, returns are low. So good for those people who do not want to take high risk. Many investors put some portion of their total money in gilt funds because they don't want to lose the principal amount. So mostly the risk is very, very low. And then there is a debt fund. Debt fund can invest in all types of debt security. Gilt fund are also debt fund, but they invest only in government securities. So they invest in debt funds, invest in debt security issued by government, private company, bank, financial institution and other entities such as infrastructure companies. So here also write down low risk, low reward, good for people who don't want to take risk, useful for parking short-term surplus, useful for parking short-term surplus money. So those investors who have temporary surplus or those who don't want to take risk, they can invest in either money market fund, gilt fund, debt fund. Now, if the investor wants to take risk, he can invest in equity funds. These are high risk, high reward mutual fund. Risk is high because they invest in equity. If the equity market crashes, the value of your mutual fund will also go down, NAV will go down, you will lose money. But if the equity market goes up, performs well, the value of your units will also rise. So high risk, high return, good for people who can invest in, who can take risk. Good for investors who can take risk, and good for investors who are long-term investors. If you can invest for a long-term horizon like 3 years, 5 years, 10 years, then in the long run it has been observed that they have given a very good return. Next is bond funds. Bond funds are such funds which invest in corporate bonds. Low risk, low return. And then there is an interesting fund called index fund. What are index funds? They invest in popular indices. Like for example, they invest in Sensex securities. So there is a plan or scheme called HDFC Sensex fund. So what these HDFC Sensex funds do, they invest in the 30 shares of Sensex. Sensex calculation is based only on 30 shares. Or there is an HDFC Nifty fund. So what they do, they invest in 50 shares which forms part of Nifty. What is good or bad about it? The good part is that the fund manager does not have to think about which security to be selected, because these 30 securities are already known. These 50 securities are already known. So that is why the word uses, they mimic the stock market. Copy, mimicry. Okay, they try to copy the stock market. So you as an investor, you want to also invest in 50 shares, but you may not have so much of money. You want to invest in 50 shares of Nifty, but you don't have necessary funds. You can simply invest in HDFC Nifty fund. Your money will be invested in the shares of Nifty, and indirectly you are investing in Nifty. So if the Nifty or the stock market goes up, this portfolio value will also go up. If the Nifty stock market goes down, then your portfolio value will also come down. For the fund manager, the task of identifying securities is less. Okay, so these are low cost fund. Otherwise, there are a lot of research to be done to identify the securities. You have to hire analysts who will guide you which security you should buy, and those analysts charges a hefty fees. So you can simply invest in index funds. But of course, you have to decide when to buy, when to sell, in what proportion to buy and sell, and then you have to try to outperform the market. If Sensex has increased by 10% in a year, index funds should generate more than 10% return. Now come to liquid funds. Liquid funds are debt funds. They invest in securities with less than 1 year maturity. So they are like money market funds. They are very liquid, good for investors who have a very short time horizon. Like corporates have surplus money for say 3 days only. Why to keep it idle? Why not to invest in liquid funds, and why not to get some return out of it? So some companies like say Infosys may have 200 crore rupees surplus funds. Why to keep it idle? Invest in liquid funds and get some return. So very popular with investors who have temporary surplus, who don't want to take risk. Investment in liquid fund is basically to park your money to get some return, but without taking much of the risk. From the point of view of ownership classification, who is the sponsor? Who is the sponsor? Public sector mutual fund. The sponsor company is a public sector company. Like we have seen some time back, UTI mutual fund, SBI mutual fund. So these are the example of public sector mutual fund where the sponsor is a public sector company. Now the SEBI has allowed private sector companies to also launch their mutual fund schemes. So here the sponsor is a private sector company. Like this example I gave you, HDFC mutual fund, Reliance mutual fund, Tata mutual fund. Foreign mutual fund, here the sponsor is a foreign company. These funds raise money in India, operate from India, and invest in India. So you have to raise money in India and you also have to invest in India. So some names here are Franklin Templeton, Fidelity, DSP, BlackRock, like this. So if you want to learn more about mutual fund, there are so many websites which give you information about mutual funds. Then there are special funds. There are some special features about these funds. International fund. What is the special feature of an international fund? They raise money in India. They are located in India, raise money in India, and invest abroad. So this kind of scheme was launched for some investor who want to buy the shares of foreign companies, but they cannot do it directly. You want to buy shares of Facebook company. So what you do? You invest in international fund. This international fund will invest in the shares of Facebook company, Amazon, Google, Microsoft, okay, Dell, and whatever. So indirectly, your money gets invested in these international companies. So that is international fund. So this is an indirect way of investing in some top companies of the world. An offshore fund is opposite. They raise money abroad. They raise money abroad and they invest in India. Raise money globally to invest locally is their credo. And one very interesting is sector fund. Tick mark important. Nowadays they are very popular. Why they are called sector funds? They invest the entire money in a particular industry or a sector. That means they will not diversify into multiple sectors. And some of the popular ones are pharma funds, tech funds, utility funds. So what pharma fund will do? They will invest only in pharmaceutical companies. You are thinking that because now there is so much of disease, pandemic, virus, this pharmaceutical company will make a lot of money because people are going to buy drugs, vaccine, sanitizer, injections, tablets, etc., etc. They will go to hospital. So in next few years we believe pharma companies will make huge profit. So you can invest in pharma funds. So they will invest in all pharma sector company like Sun Pharmaceutical, Cipla, like that. Okay. There are so many. Tech fund will invest in technology companies. Next few decades will be ruled by technology. Technology is required everywhere now. Medicine field, education sector, entertainment, okay, running a business. So therefore you think that tech companies will do well in the near future or years to come. So you want to invest in technology company. You don't want to invest directly in technology company, you can invest in tech fund. Or then there are utility funds which invest in utility industry like power, gas, telephone. There was one PSU fund also by some mutual fund. They invest in the stocks only of public sector companies. Then there is a banking fund which invest in the stock of the banking companies. So if you have a view that this industry will perform well, then you can invest in that kind of special fund. The disadvantage is no diversification benefit. Usually you will find mutual funds offer diversification benefit, but not in case of sectoral funds, because they are going to only invest in particular sector. So if the banking sector goes up, all the shares will go up. If the banking sector does not do well, all of them are not going to perform well. And the last special fund you tick mark for exam purpose is sector funds. Funds of funds. So what is a fund of fund? A mutual fund which invest in other mutual fund scheme. You are the investor. You invest in mutual fund A, and this mutual fund will invest in mutual fund B, mutual fund C, mutual fund D. So that is called funds of funds. So this is a very special fund where a mutual fund is investing in other mutual funds. So why fund of funds were launched? First question is why mutual funds were launched. Mutual funds were launched because people did not have the expertise, the knowledge, the power to invest directly in the stock market directly, the inclination to invest in the stock market directly. So government started with Unit Trust of India, and it told people that you don't worry, You invest in mutual fund and then they will take all the decision relating to investment. But then in the last 50 years, what has happened? The number of mutual fund houses have multiplied. So now we have more than around 45 mutual fund houses. We have more than 45 mutual fund houses, and one mutual fund house can have many schemes. A mutual fund house can have many schemes. Some of them can have 40 schemes, 50 schemes. The problem will be now, if there are 45 mutual fund house, UTI is one mutual fund house, SDFC is one mutual fund house, Kotak is one mutual fund house, and they have around 50 different schemes. So how many options I have to choose from? 45 into 50, I have to choose from 2250 different schemes. The solution was invest in mutual fund and then don't worry where they will invest. Now the problem is which mutual fund I should choose, whether I should choose this mutual fund or this or this. So somebody came with an idea. Now you don't worry about which mutual fund you have to choose. You invest in such a scheme which will choose further in which other mutual fund they have to invest. So one example is printed here, Kotak Flexi Fund. Kotak Flexi Fund. Fund of funds. So what you do as a homework today, if you are interested, you try to find out various types of funds, some practical example like which companies, then you find out the sector funds, you find out the names of few growth fund, income fund, debt fund, liquid fund. So this will create some interest in what is happening around you. So there are a lot of websites like moneycontrol.com. Some of you may have on your mobile phone also, which gives you continuous updates about share market and mutual funds. Then this body of mutual fund is called AMFI, Association of Mutual Fund of India. They also give you information about mutual funds. Now we are entering into the practical topics now. The theory part is okay, but most of the questions in the exam so far have been asked from practical part. We have only just done one small practical part, calculation of entry load, exit load, repurchase price, sell price. But in the exam now they are going to ask you different types of problems. First, today we will see calculation of NAV, that is net asset value. So you have to come to paragraph number 16. Paragraph number 16, NAV calculation. What is NAV? It is the amount which a unit holder will get if the mutual fund were wound up today. If I sell all the asset, if I sell all the assets, if I pay all the liabilities, and I distribute this amount which is called net asset over the total number of outstanding units. If I distribute this amount over the number of units outstanding, how much each unit will get, how much the holder for how much one unit will get, how much amount you will get per unit is called NAV. To make your understanding simple, suppose the value of the assets of this is 10 lakh and there may be some 20,000 liabilities like fees payable to the fund manager, divide by number of units 1 lakh. So the value of your assets is 10 lakh. Type 10 lakh on calculator minus there may be some accrued liabilities, some salary payable or fees payable, and then divide by number of outstanding unit 1 lakh. So that you are getting 9.80. This is NAV. As simple as this. Sir, this we have done in our accounts also. In amalgamation chapter, absorption chapter, there also we used to do the same thing. Take the market value of assets minus liabilities payable, divide by number of units. That gives you net asset value per unit. And this is the rate at which you buy units, this is the rate at which you redeem units, subject to entry load and exit load. Point number 2, the NAV of a mutual fund scheme may be calculated by dividing the net asset by number of units of that scheme on the date of valuation. As you know, these mutual funds are required to calculate their NAV on a daily basis now. The investor subscription is treated as unit capital in the balance sheet of the fund, and the investments are made on their behalf are treated as asset. So what they will do, they will see how much assets a scheme holds, how many units are issued under a scheme, what are the liabilities of that scheme, and then they will compute the net asset minus liabilities. After computing asset minus liabilities, they will divide by number of units, they will get NAV. Then your question would be, how is net asset calculated? So they will make a list of the assets of that scheme. This is a mutual fund, so most of the assets are nothing but investment, market value of investment. Plus there may be some receivable like interest receivable, dividend receivable. Though there can be some other accrued income like interest, dividend, or any other asset like cash in hand, because not everything is invested, some cash in hand, some cash at bank would be there, and minus any liability like accrued expense or other payables like fees payable or any other liability like expenditure payable. So that they will specify in the question. First you find out the assets of the scheme, add it, wherever possible take market value, wherever possible take market value, then identify the liabilities of the scheme, deduct the liability, you get net asset, divide by number of units outstanding, that will give you NAV. Okay. What is the benefit of the NAV? The benefit of the NAV is that it is useful for assessing the return that an investor has earned. So you please write down this line also. The purpose of NAV, one, as we have seen, to find out the sell price and repurchase price. Second benefit is you can compare the NAV at which you bought and the NAV on the valuation date or on the selling date, and you can compare the return that you have earned. So understand once again, suppose on 1st January you bought units, NAV was 24, and suppose on 31st December the NAV was 28. No other details are available. So what is the rate of return? The rate of return will be 28 minus 24 divided by 24. So 4 divided by 24 into 100. So that comes to around 16.67%. So for example, in mutual funds like growth scheme, this way the returns are calculated. If no dividend was paid, this is how the return will be computed. If dividend is also received, then you will add the dividend also, no problem. NAV changes daily. NAV changes daily. Underline this, write down this also. NAV changes daily. Why? Because the value of the assets and liabilities also changes daily. NAV changes daily because the value of assets and liabilities changes daily. NAV today will not be NAV tomorrow or a day later. NAV today will not be the NAV tomorrow or day later. So every day NAV will change. So don't postpone your decision to buy or sell unit, because NAV may change. If the market price of the securities have gone up, tomorrow NAV will go up and you will have to buy the units at a higher rate. So NAV today will not be NAV tomorrow or day later. So now we'll first do some basic question on NAV calculation, right? Just be little aware what is happening around you. Use common sense. The purpose of NAV calculation is to know what is the amount per unit an investor will get if this scheme is closed today. Wherever possible, take market value. If not possible, take the book value. Like for example, for cash in hand, we can take book value. For unlisted company share price, unless something is given, one can take the cost at which it was acquired. So please come to one question on the next page, 8 number, a easy question to begin with. This was asked in RTP, but nowadays they don't ask such questions. Source of this question was RTP. Name of the scheme, mutual money fund, money plant. What a wonderful name, money plant. This kind of names earlier were given to attract the investors. Now the investors have become smart. Size of the scheme is 100 lakh, face value of the unit. In fact, they should not write share, but earlier they used to write it to confuse the people. Normally share prices can appreciate very fast, but not for units. Units will have to invest in the share market, and then when the share market will appreciate, then units will appreciate. So avoid the use of the word share here. Number of outstanding unit 10 lakh. Market value of the fund's investment is rupees 180 lakh. Receivable rupees 1 lakh. Accrued income rupees 1 lakh. So these are my 3 assets. Liabilities 50,000, accrued expenses 50,000. So we have to first identify assets and liabilities, then take them at their market values. So already market value of investment is given. For other items we can just take them at their book values. Calculate the NAV per unit. Calculate the NAV per unit. So write down calculation of NAV per unit. Calculation of NAV per unit. Serial number, particulars, rupees. First we'll write point A, assets. Under that one write down investments. Tell me the investment amount. Rupees in lakhs. 180.2. We have receivables 1, 3. Accrued income 1. So then you write down total of assets 182. Point B, liabilities. Under that one, accrued expenses. How much is accrued expenses? 50,000. So I will write 0.5 and 2. Then other liabilities. Other liabilities can be 0.50. Total B is 1. Point C, net assets A minus B 181. Point D, number of units in lakhs. Very easy. So we will look at the number of units 10 lakhs, and point E write down NAV per unit in rupees. NAV is in rupees. So that you write C by D. C upon D, rupees 18.10. Is it rupees 18.10? Correct. Now come to next question number 9. The following portfolio details of a fund are available. Fund has accrued management fees with the portfolio manager totaling rupees 30,000. So this is a liability. Fees payable to the fund managers. There are 40 lakh units outstanding. What is the NAV? And then this scheme has only 4 stocks. Number of shares are given, price is given. So what we'll do? First we'll find out the value of the investment, and then we'll deduct the liability, and then we'll divide by 40 lakh units outstanding. So these are the warm-up problems. Problem for the beginners, starters, and then we'll take few exam questions also. You will realize then the level of the institute. This is just warm-up. Have patience. Write down the heading, calculation of net asset value. Calculation of net asset value. Under that write down first point number A, assets. Point number A, assets. Same format, serial number, particular amount. Point number A, assets. Under assets, inside that particular column, you write down 3 headings. Point A is assets. Under that write down shares, number of share, price. Same format you can follow, no problem. A, B, C, D. Number of shares 2 lakh, 3 lakh, 4 lakh, 6 lakh. Price 35, 40, 20, 25. So what I'll do, I'll take my calculator and multiply 2 lakh into 35, 70 lakhs. 3 lakh into 40, without calculator, 1 crore 20 lakh. 4 lakh into 20 without calculator today, 80 lakh. 6 lakh into 25, 1 crore 50 lakh. And then take the total, it comes to 4 crore 20 lakhs. Point number B, write down liabilities. Under liability you have accrued expense, that is fees payable. Fees payable to portfolio manager. Fees payable to portfolio manager. Fees payable to portfolio manager. How much is that given in the starting line? 30,000. So therefore net asset will be 4 crore, how much? 19 lakh 70,000. 4 crore 19 lakh 70,000. Point number D, write down number of units. Number of units is 40 lakh. Number of units 40 lakh. So now you take your calculator, 4 crore 19 lakh 70,000 divide by 40 lakhs. So that is 10.4925 rupees. C by D. C by D. 10.4925. So that was another simple question. Come to question number 11. Question number 11 is one more simple problem. A mutual fund's balance sheet is as follows. Liability rupees in crore, asset rupees in crore, unit capital, reserve and surplus, current liabilities. So what you get from this number will be useful. 50 crore units are there and the current liability is 150. Then asset side we have equity share, debenture, money market instrument, other current asset. Total. Now the problem says if the value of the equity investment, means first one, moves up to 1200. Suppose its market value goes to 1200 and the debenture moves down to debenture. This is debenture, it moves down to 300 crore. What is the new NAV? New NAV means I have to find first old NAV also. So I will compute based on this data and based on revised data where equity share and debenture value will change. Do you agree? So whether you agree or not, write calculation of NAV. Calculation of NAV. 2 columns on the right side. Old NAV, new NAV. Serial number A, assets. Old NAV, new NAV in one table only. So asset side we have 4 items. Equity shares 900 and the market value after the change has become 1200. Debentures, earlier it was 350, now it has become 300. Money market instrument 145 because question has not mentioned anything about money market. Now other current assets, other CA, don't write CA, current asset 105. Total of A. So what is the total of A? This one will be 1500 because I have not changed. Second one 1200 plus 300 plus 145 plus 105, 1750. Point B, write down liabilities. Under that current liabilities 150. Point C, net assets A minus B 1350 and 1600. Point D, number of units in crores, 50 crores, 50 crores. Point E, NAV in rupees, C by D. So 1350 divided by 50, 27, and now 1600 divided by 50 is 32. So this is the NAV. These three questions were warm up. Warm up exercise is over. Match practice is over. Now we'll come to meet the institute from the near distance. Question number 10. May 2010 exam. Repeated some more times. We'll take one repeat question also. So this type of question they are asking for anything from 4 to 8 marks. So I will give you a chance also to try. Based on the following data, determine the NAV of a regular income scheme. Listed shares at cost, cash in hand, bonds and debentures at cost. Of these bonds, bonds not listed and quoted. So there are two types of bonds. Read carefully. Out of this there are two. Unlisted is one, and there must be some listed also, which is mentioned below. Other fixed interest securities at cost, other than bonds and debenture. Dividend accrued. Now whether dividend accrued is an asset or a liability. Here their students had made mistake in the exam. The word accrued does not mean it is a liability. Dividend can accrue on your investment also. You have invested in equity shares, so therefore dividend might have accrued. So dividend accrued is an asset, and if you make mistake here, your entire answer will go wrong. Next is amount payable on share. This is of course liability. Expenditure accrued is a liability. So these two are liabilities. These 6 items are assets, and now we have to check for their market values wherever available. The current realizable value of fixed income securities, so they are talking about this. The current realizable value of fixed income security of the face value of rupees 500 is rupees 106.50. So 4.50 is the cost. Face value today, if 100, its realizable value is 106.50. So now you have to find out what is the realizable value of this other fixed interest security, and that amount you will take for NAV calculation. So this is linked to this adjustment. Then next line, all listed shares were purchased at a time when index was 1200. On the NAV date, the index is ruling at 2120. So tick mark this. When index was 1200, the value of your share was 20 lakh. So now when index is 2120, what will be the value of your share? So it will change proportionately. Listed bonds and debenture carry a market value of 5 lakh on the NAV date. So we have discussed about these bonds and debenture. Unlisted, listed. Listed is 5, unlisted is 1 as mentioned here. Now I will give you 15 seconds to try everything I have explained. You can see there. You have to just do the calculation and tell me what is the NAV of this problem. Even if you go wrong, don't worry, I'll dictate the answer. But first I want you should try. Please try. I have told you there are 6 assets, 2 liabilities. Some items have been given market values or realizable value. Take that. Wherever not given like cash in hand, take the book value. Are you trying? 5 seconds more. Then we'll check the answer. Okay. So be ready with your answer. I am going to check now. Okay, come on. Check the answer. First you write down calculation of NAV. Heading is calculation of NAV. Serial number, particulars, rupees in lakhs. Serial number, particulars, rupees in lakhs. Point number A, assets. Under assets, first write down shares. Calculation, write down in bracket 20 into 2120 divide by 1200, that is 35.33. 35.33. Question in front of you. Next item is cash. Nothing is mentioned. Take book value 1.23. Listed bonds. Bonds and debenture I will divide into 2 lines. Listed bonds and debenture, right? Listed bonds and debenture 5. Listed bonds and debenture 5. Unlisted bonds and debenture. Unlisted bonds and debenture 1. Other fixed interest securities. Other fixed interest securities, we have to take them at their realizable value. We have to take them at their realizable value. 4.50 into 1.60, 106.50 divide by 100. 4.50 into 106.50 divide by 100, and that is 4.7925. kindly check. 4.7925. Then dividend accrued also you will add. Dividend accrued is how much? Same figure, book value 0.80. Take total of these assets. Take total of these assets. Take total of these assets. Check how much you are getting. Are you getting 48.1558? Let me also check. Approximately check. Suppose the first number I take 35.33. 33. 2 more times 33. 35.3333 and plus 1.23 plus 5 plus 1 plus 4.7925 plus 0.8, and that is equal to 48.1558. Point number B, write down liabilities. Under liabilities, write amount payable on shares, little fast, 6.32. Expenses accrued 0.75, total B 7.07. Point C, net assets A minus B, net asset A minus B 41.0858, 41.0858. Point D, number of units in lakhs, number of units in lakhs 2.40, number of units in lakh 2.40. Point E, NAV in rupees, NAV in rupees C by D 17.1191, 17.1191. This answer is over. Now we'll take a break.